before Jackson Hole, well, even just going back to 2 to 3 weeks ago, the market was expecting the Fed to be done by the end of this year and potentially cut rates by 2023, which I think is really difficult to achieve because unless you have a material slowdown in the U.S. economy, the Fed is not going to cut rates in 2023. How do you get there? You have to have interest rates much higher than where we are now. So the scenario of modest hiking, then rate cuts next year, I think that's just really difficult to get there. So what we've seen this week is effectively the market starting to readjust their view. And again, right. Jackson Hole is going to be absolutely critical. And to me, we could still see some volatility in the market, especially for some of the more rate-sensitive sectors and components in the risk market.
And that's the real trick, isn't it? The readjustment process. Where are we in that cycle, Ty? And if I can put some numbers on it, are we looking at 3.25, 3.5% on the 10-year yield? And if so, then that implies there's repricing on the NASDAQ, there's repricing on the growthier end of the market. And given the weighting that tech has, markets broadly, there's still some wood to chop here in terms of downside risk, yes?
Yeah, I think in the next 2 or 3 months, the range you've mentioned, 3.25, 3.5, that's certainly plausible. Again, they're very much depending on the job market and the inflation numbers coming in. And that's why we think, at least for now until the end of the year, it makes sense to have a stronger preference for fixed income rather than equities. Now, if you are an investor looking at the next 2 to 3 years, the story is different because valuation, especially in the tech sector, those have adjusted to a great extent. It may not be fully adjusted. So the next down leg is less relevant to long-term investors. But your question is very much based on if a tactical investor looking at the next 2 or 3 months, I do think there's still a little bit more volatility to come.